Hello, class. I want to spend some time reviewing the what I would refer to as the flow of costs in a manufacturing environment. As we move from financial accounting to managerial accounting, we're focused more on manufacturing companies who actually turn raw materials into finished goods. Assuming you've read through chapter 1 of your textbook, you've learned some new terms, including raw materials, work in process, finished goods, and how that relates to what we're talking about. What I want to show you is this problem you see on your screen is similar to the review problem at the end of chapter 1, with some different numbers and bigger numbers and a few more numbers. And also, I want to make sure that you understand how this relates to journal entries and T accounts, that you can picture that process in your head in terms of the T accounts. Later on, as this becomes more complicated, we will use these T accounts to sort things out throughout the rest of this semester. And this flow of costs is really what we will work on and revolve around for the rest of our time in Accounting 200. So as we look at the information here on the left, this is given to us in some way or another from our calculations, whether we did it during the accounting period or so forth. But the beginning raw materials that you would have is also the beginning balance in our raw materials inventory T account. So raw materials is an inventory. This is the stuff we buy, haven't done anything to them. During the period of time we're measuring, we would purchase more raw materials. That would include everything we need to do for our manufacturing process, and that would be a debit to raw materials and a credit probably to accounts payable. And I have left that T account off of this so that we could focus on the cost flow through the inventory T accounts that we are focused on in this section of learning. Now, at the end of the period, we can count up what we have left, and we subtract that from what we bought and what we had to start with, and that is how much we used. Now, perhaps a better way to figure out how much we used is to actually keep track of it during the accounting period by using what we refer to as materials requisitions, things that are needed in the process of manufacturing our product. Well, in this case, either way, whether you do it by tracking it all through the period or at the end when you count up how much you have left, we determined that we used $3,072,204 worth of materials. Of that, 109,712 was indirect, and there's reading in your on the desire to learn as well as your textbook about the difference between direct and indirect. But these are the ones that would be hard to trace to particular cost product. These are the ones that we can clearly see a relationship between what we've done and the cost of the materials. So it's important that we determine that difference because, as you see in the T accounts, the 2962,492 goes to work in process. So the direct cost goes directly into work in process, the next inventory account, which had a beginning balance of 61,305. We'll come back to that. The 109,712, the indirect cost, goes to factory overhead, and that's really critical about indirect. Indirect costs go to factory overhead because the point is you cannot directly trace them to a cost object, so we put them in factory overhead and then allocate them, and that's much of what we will spend some time in later chapters talking about, is that process of allocating. Now, direct labor is next. We have materials used, goes into work in process. Direct materials, indirect over here. Direct labor, because it cannot be stored up. We have to use it and pay for it in the same period. That often does not have its own T account, but you certainly can use one called payroll or labor or something like that, where you would pay for it on the debit side and then use it in the credit side, but it would always be zero. We're going to directly debit it to work in process, and the credit would be to either cash or salaries payable or wages payable, depending on the timing of the payment. And again, I left that other part off of our journal entry. So you can see that now in our work in process we have materials, direct materials, and direct labor. Now, during the accounting period, we also are going to have some other indirect costs, overhead costs. You can see some of the examples of perhaps things you might see. We've got our indirect materials we talked about already, but we'd also have things like indirect labor, like supervision and repair and maintenance may have some labor, some indirect labor. So those are all here, and they're debited to an account called factory overhead. Just like the indirect materials, you have 6 items in factory overhead, 6 debits. So the actual factory overhead costs as they are paid or accounted for are debited to factory overhead, credit cash, or accounts payable. Now, looking at our work in process, we have the beginning balance, 61,305, ending work in process, 47,235. See, that's the ending balance there. Now, what we're taking here is we're adding the direct, taking the beginning balance, adding the direct materials, adding the direct labor. All of the factory overhead is credited here and debited work in process. We use all the factory overhead, all the actual factory overhead. Later we'll learn how to estimate that a little differently. But right now we'll take the entire amount and debit to work in process. So there's your total costs. Subtract out what you have left. Again, a better way to do that is to track it during the accounting period. And as we finish an item, it is moved from work in process to finished goods. Credit work in process, debit finished goods. And that is the cost of goods manufactured. All of these were finished, manufactured, and moved to finished goods. That cost of those, which can either be calculated as you go along or by taking the total costs minus what's left in work in process, to get finished goods. Now over here in finished goods we have a beginning balance, and you see that over here as well as at the top of our T account. We take the debit from work in process. The credit was over there, now it's debit here. And then you have what you have left over in finished goods, 212,769. The difference is cost of goods sold. That's a credit to finished goods, which would be better kept track of as you go along during the accounting period. Each time you sell something, the cost of it would be credited to finished goods and debit cost of goods sold. So just as you see at the bottom of this, that would be part of your income statement. Sales minus cost of goods sold, which would have all these other pieces to calculate, but are almost never shown on the income statement for real, in real life. Get your gross margin like we're used to in Accounting 101. Then subtract out marketing expenses, insurance, administrative. These are our period costs, our non-manufacturing costs, to get our net income, ignoring taxes at this point. So that's how this process works, both in the calculations, this method, and in the T accounts. You see it's the same process, same numbers, same add, subtract, so forth, but kind of 2 different ways of looking at it. And to be real honest, when you have it complicated, this one is actually easier to keep track of, and it's certainly the way it's done in real life, because you're tracking it on an ongoing basis rather than just once a end of the period.